If you closely observe the portfolio of Mr. Mukul Agarwal, one pattern becomes quite visible. He likes to take position in companies that are operating in emerging sectors before the broader market fully appreciate the opportunity. And that's where in today's video, I want to discuss three such interesting bets. One is linked to semiconductor and AI, another is a pharmaceutical ingredient company, and third, operate in precision engineering. All these three themes have massive growth potential. But before we proceed further, let me make it very clear that this is not a stock recommendation. If you are looking for a buy or sell call, you can skip this video. Also, just because Mukul Agarwal has invested in a company does not guarantee that the stock will become a multi-bagger. Investing is not as simple as copying a name from a shareholding pattern and expecting extraordinary return. Even the best investors are wrong sometimes. More importantly, their entry price, position size, risk tolerance, and investment horizon may be completely different from yours. As a retail investor, our job is not to blindly follow an investor. Our job is to understand the investment thesis and then continuously track whether the thesis is actually playing out or not. And there's always a possibility that Mukul Agarwal may reduce his stake or even exit completely in the future if the original thesis changes. So please treat this video as an exercise in understanding businesses and investment mindset, not as a buy or sell call. The goal is to understand why a seasoned investor like Mukul Agarwal may be interested in these companies and what are the key factors investors should monitor going forward. Alright, let's get started. So the first company in the list is ASM Technology. Mukul Agarwal invested in ASM Technology in September 24 and then he increased stake in September 25. Now at a first glance, ASM Tech looks like a small engineering service company. But if you go one layer deeper, company is actually positioned at the intersection of multiple long-term themes. It has exposure to semiconductor engineering, embedded systems, electronics, automotive technology, industrial automation, and now increasingly artificial intelligence. Now think about what is happening globally. Countries are investing billions of dollars into semiconductor manufacturing and chip design capability. Companies are redesigning supply chain to reduce dependence on a single geography. At the same time, AI is driving massive demand for computing power, advanced electronics, sensors, and semiconductor innovation. If India emerges as a meaningful engineering and design hub in this ecosystem, companies like ASM Technology could become beneficiary of this trend. Now, one of the reasons investors like Mukul Agarwal may be excited about ASM Technology is that management is not trying to build every capability internally. Instead, company appears to be following a capital allocation strategy where it uses funds raised through preferential issues to acquire or partner with businesses that already possess niche technology and expertise. This allows ASM to accelerate its presence in emerging technology without spending years developing those capabilities from scratch. A good example is investment in Meline Foundry. Through this transaction, ASM gained access to edge AI and physical AI capability that can be deployed in industrial automation, manufacturing, semiconductor, and electronics application. Rather than merely talking about AI opportunity, companies actually attempting to bring AI capability directly into real-world industrial environment. If successful, this could help ASM move beyond traditional engineering services and participate in higher value technology solution. Likewise, the partnership with HHV provides exposure to precision manufacturing and high vacuum technology. High vacuum systems are critical in industries like your semiconductor, electronics, aerospace, advanced manufacturing, and scientific equipment. By combining ASM's software engineering capability with HSV's hardware expertise, company could potentially participate in opportunities that require both digital and physical engineering capability. Another development that fits neatly into ASM Technologies' broader strategy is its association with SMITH wireless technology. SMITH specializes in areas like RF engineering, wireless testing, network optimization, and emerging communication technology. These capabilities become increasingly relevant in industries like 5G, private wireless network, industrial IoT, connected devices, autonomous system, and smart manufacturing solution. So if we try to connect all the dots, the strategy starts becoming clear. Meline Foundry adds AI and edge AI capability, then HHV partnership adds advanced manufacturing and precision hardware capability, and then SMITH wireless technology adds wireless communication and telecom engineering capability. Together, these initiatives suggest that ASM is attempting to create a diversified deep tech engineering platform rather than relying on a single service line. This is likely one of the reasons investors like Mukul Agarwal remains optimistic. The market may currently see is at a small engineering service company, but the bullish thesis is that ASM is gradually assembling capabilities across several high-growth technology domains that could actually become increasingly valuable over the next decade. Financially, company has been growing at a very fast rate. However, valuation-wise, market is giving it a lot of premium based on the future earning potential. So this is one risk you need to keep in mind. Company still needs to demonstrate sustained growth, improve execution, win larger customers, and successfully monetize emerging opportunities in semiconductor and AI. If execution falls short, market expectation can reset very quickly. Second company in the list is Sudeep Pharma. Mukul Agarwal has recently made an entry in Sudeep Pharma. So if you look at this company on the surface, it appears to be a niche pharmaceutical ingredient company manufacturing mineral-based excipients for the global pharma and nutraceutical industry. But if that was the entire story, it would be difficult to explain why investors like Mukul Agarwal have shown interest. The real investment thesis goes much deeper than the current pharmaceutical business. The first and perhaps the most important part of the bull case is what is called the EV battery material. Company is making a significant strategic move through Sudeep Advanced Material. Leveraging its decades of expertise in producing food-grade iron phosphate, company is setting up a battery material plant in Dahej with capex of 300 crore, where it will produce battery-grade iron phosphate for electric vehicle and energy storage system. This is likely the hidden catalyst that attracted Mukul Agarwal's attention. He's not merely valuing the existing business, but looking at the possibility that Sudeep becomes a critical supplier of LFP battery ecosystem over the next decade. Then second reason for optimism is company's strong competitive moat in its core business. Pharmaceutical excipients are not commodity product that can be switched overnight. Sudeep has spent decades building manufacturing capability, quality system, regulatory approval, and customer relationship. Company operates multiple globally certified facility and exports to more than 100 countries. Another factor that stands out is the company's financial profile. Sudeep consistently generates operating margin in the mid-30s range, which is exceptionally strong for a manufacturing business. At the same time, company has historically delivered healthy return on equity and return on capital employed, indicating that management has been able to deploy capital efficiently. Now, obviously, businesses that combine high margin, strong return on capital, and long-term operating history often attract quality-focused investors because they demonstrate both competitive strength and disciplined execution. When viewed together, the investment theses become quite clear. Investors are getting a profitable, export-oriented niche pharma ingredient company with strong entry barrier while also receiving a potentially valuable call option on EV battery supply chain. If the battery material business succeeds, the future earning profile of the company could look very different from what it does today. This asymmetry between current perception and future potential is often what attracts investors looking for multi-year compounders. However, the thesis is not without risk. One of the key concerns is customer concentration. A meaningful portion of company's revenue comes from a relatively small number of large global customers. Any loss of a major client or regulatory issue or slowdown in export demand could impact the earning growth. So investors should carefully continue tracking customer diversification and export performance. Then the bigger risk, however, lies in the EV opportunity itself. So their 300 crore capex into battery material represents a major strategic expansion beyond company's traditional business. So execution will be very critical. Delays in commissioning, lower than expected utilization, technological changes in battery chemistry, or weaker EV adoption could impact all the expected return from the investment. So market is already assigning value to this opportunity, which means execution mistakes could be punished severely. Valuation is another important consideration. The stock trades at premium multiple because investors are pricing in future growth from both core business and EV material business. So at such valuation, company has very little room for disappointment. Even a few quarters of slower growth, margin pressure, or project delays can lead to sharp correction. So if I have to summarize Mukul Agarwal's thesis in one sentence, it would be that Sudeep Pharma is not merely a pharma excipient company. It is a high-quality niche manufacturer with strong global entry barrier that also possesses a potentially transformational EV battery material opportunity, creating the possibility of a much larger business over the next decade if management executes successfully. Then third company in the list is Wendt India. Mukul Agarwal entered this company last year. At first glance, Wendt India may not look like the kind of company that attracts investor attention. It operates in a niche segment of precision engineering, manufacturing super abrasives, grinding wheels, honing solution, and advanced machining equipment that are used in industries like aerospace, automotive, bearings, defense, engineering, and industrial manufacturing. For decades, Wendt India operated as a joint venture between Murugappa Group's Carborundum Universal and Germany-based Wendt GmbH, which was itself a subsidiary of global industrial giant 3M. Because of this structure, Wendt India benefited from global technology, strong manufacturing know-how, and access to international expertise. However, being a joint venture also means certain limitation. Like many multinational JVs, strategic decisions often had to align with the interest of both partners, and export opportunities could sometimes be constrained by global footprint of the foreign parent. This is where the story gets interesting. In what may turn out to be the most important event in company's recent history, when GmbH decided to exit its entire 37.5% stake through an offer for sale. Normally, when a multinational parent exits a business, investors panic. Market often interprets this as a signal that something is wrong with the company. In fact, that's what happened. Stock tanked more than 60% from December 24 highs. But sophisticated investors often ask a different question. What changes after the exit? The biggest development was not the stake sale itself. The biggest development was that Wendt India simultaneously acquired complete ownership of Wendt brand and trademark across nearly 40 countries. Now, why this is important? So historically, Wendt India operated under the umbrella of global parent. While that brought technological advancement, it also meant that company could not always aggressively pursue international opportunity that overlapped with the parent's market. With the trademark acquisition, Wendt India effectively becomes the owner of Wendt brand across large number of countries. For the first time in the history, company can independently build global distribution channel, expand export, pursue customer across international market, and develop its own global identity without seeking approval from a foreign parent. In simple words, Wendt India is no longer a restricted Indian subsidiary. It now has the freedom to become an independent global precision engineering company. The second reason this transition is important is the company's decision to establish its own subsidiary in Germany shortly after the parent exited. At first glance, this may seem contradictory. If German parent has exited, why set up a German subsidiary? The answer lies in market access. Germany remains one of the world's largest hub for advanced manufacturing, precision engineering, industrial automation, machine tools, and aerospace components. By establishing a direct presence in Europe, Wendt India gains proximity to customer, distributors, and engineering ecosystem that were previously harder to access independently. Yes, the initial setup cost would hurt the profitability. In fact, operating margin temporarily contracted as the company absorbed the cost associated with international expansion and transition process. But from long-term perspective, management is willing to sacrifice some near-term profitability to build a much larger global opportunity. Then third pillar of the thesis is the consolidation of control under Murugappa Group. Following exit of Wendt GmbH, Carborundum Universal became the sole promoter with 37.5% stake. This may appear like a small governance change, but it can have significant strategic implication. With a single promoter now in control, decision-making becomes simpler and faster. More importantly, Murugappa Group has built a reputation for capital discipline, operational excellence, and long-term value creation. Investors may be betting that Wendt now can pursue growth opportunity more aggressively under a unified ownership structure. When you put all these pieces together, the investment thesis becomes much bigger than a precision engineering company. The market initially focused on the short-term negative like the promoter exit, margin pressure, transition cost, and temporary uncertainty. As a result, its stock price tanked badly. But investors like Mukul Agarwal may be seeing a company that has moved from being a restricted joint venture to becoming an independent global engineering franchise. A company that now owns its own brand. A company that can pursue exports without geographical limitation. A company that is establishing a direct presence in Europe. A company backed by one of India's strongest industrial group, and a company operating in niche segment like your aerospace, industrial automation, defense, bearings, and precision manufacturing, all of which are expected to benefit from global manufacturing and engineering upcycle. Yes, the near-term numbers may fluctuate. Margins may remain volatile during the transition period, but the bull case is that company has traded short-term earning pressure for long-term strategic freedom. And if management executes well, the Wendt India of 5 years from now could be very different company from Wendt India that existed under the old joint venture structure. In conclusion, what ties all three companies together is not just Mukul Agarwal's shareholding, but the nature of the bets themselves. These are not simple, cheap stock ideas or pure momentum trades. They are early positioning bet in businesses trying to align themselves with large, long duration structural shift. ASM Technologies is essentially a play on India's gradually moving up the global value chain in semiconductor engineering, embedded system, AI-led industrial solution, and precision design. Sudeep Pharma, on the other hand, is a much more stable core business layered with high risk, high potential option on EV battery material. Wendt India is about a joint venture turning more into an independent global engineering franchise with ownership of its brand and direct access to international market. Here the key debate is whether the temporary pain from transition cost and margin pressure eventually convert into sustained export-led growth and global positioning in precision engineering. So Mukul Agarwal entry is only the starting signal. The real work is in tracking whether the story actually unfolds the way the market is currently imagining it or not. Now tell me in the comment, which company do you find most promising? I hope you'll find this video useful. If yes, do share it within your circle. I'll see you in the next video. Till then, take care.